Alright everyone, welcome back to the channel. Today, we're diving into the stocks that have caught my eye this month for potential buys. We're seeing some familiar names on the list, and given the recent market movements, the list has certainly grown. However, there are also some notable exclusions that might surprise a few of you. Stick with me, hear my reasoning, and then you can decide if you agree or disagree with my approach. I'm going to walk you through the specific stocks I'm looking at and the logic behind each selection. There's quite a bit to cover, so if you appreciate straightforward analysis without any unnecessary hype, make sure to hit that like button. That's exactly what you're going to get here today. Now, keep in mind that the stocks I'm highlighting today are those that currently present the most compelling discounts based on my own valuation framework. This process of valuation is, in my opinion, the most critical skill you can develop as an investor. For some of you watching, your own analysis might lead you to different conclusions, and that's perfectly fine. Ultimately, I can only share the stocks that align with my investment strategy and current targets. These represent, for now, the best opportunities according to my plan, my portfolio, and the stocks I am actively considering for purchase. Again, there are numerous excellent companies out there, many trading at attractive prices. I'm not disputing that. I'm simply focusing on the ones that fit my specific criteria for buying right now. The first stock on my list is Google. Honestly, I'm a bit perplexed by the ongoing narrative that they're somehow falling behind. In my view, they remain the undisputed leader in their core areas. When it comes to search, and perhaps even more importantly, advertising, no one executes better than Google. You could certainly argue for Meta as a close competitor in the ad space, and I'd agree they're in a very strong position, essentially neck and neck. But beyond these two, the competition is significantly further behind. So, I don't see much point in debating their dominance in these key revenue-generating sectors, which, when we're talking about stocks in the stock market, is what truly matters, not the surrounding noise. Now, I acknowledge the ongoing news regarding the Justice Department and potential antitrust concerns. This isn't a new development, and we've seen similar situations with other big tech companies in the past. Typically, these issues take years to unfold, involve numerous legal processes, and often don't result in drastic outcomes. Even in a scenario where Google was forced to separate its business units, as a shareholder, I might actually benefit from owning shares in two distinct, highly profitable entities instead of one. The fundamental point is that all of Google's various business lines are significant moneymakers. It's crucial to understand this, and even more importantly, to grasp the significance of share count for long-term investment returns. This is a key metric for any serious investor. Moving on to the second stock on my list, we have PayPal. It's almost become a running joke how this company seems to struggle to gain consistent upward momentum. It's as if the market just can't decide what to make of it. I appreciate the direction that Alex and the management team are taking the company. We have their earnings coming up soon, and I'll be sharing my thoughts on that separately. Personally, I already hold a significant number of PayPal shares, so I'm not actively looking to add a large position at the moment. Yes, it's trading at a substantial discount, which is why it remains on my watchlist. There will likely be a point where the valuation becomes too compelling to ignore, and I'll add another tranche of shares. But for now, while it's in a buyable range according to my analysis, I'm not in a rush to significantly increase my holdings. I do have positive expectations for the management team's execution this year, with even greater potential in 2026. Nevertheless, the stock has seen another downturn, and it's PayPal. Next up is Sophie. You all know I've been a long-time advocate for this stock, going back to when it was trading around the $4 mark. Of course, there were many who predicted it would fall much lower, but the underlying fundamentals of the company were strong then, and they remain strong now. We have their earnings report coming up, and I'll be providing my detailed analysis in a video shortly, so make sure you're subscribed with notifications turned on to catch that. From my perspective, Sophie continues to move in the right direction. Despite occasional skepticism from Wall Street and a stock price that doesn't always reflect their progress, the strategic moves they are making are incredibly positive and are setting the stage for significant bottom-line growth, which is paramount. Now, with Sophie specifically, I urge you to disregard any talk of super squeezes or overly optimistic price targets like $45 or $75 by year-end. Focus on the actual business fundamentals and perform your own valuation based on the management's projected earnings per share in the coming years. This will give you a much clearer picture of the true opportunity here. For me, I still believe SoFi is undervalued. And frankly, if the market wants to continue to push it down, as we saw with our ability to add shares in the $9 range, I'm happy to keep accumulating at these levels. The fourth stock I want to discuss is Amazon. It's no secret that I'm a big fan of Amazon. It's a fantastic business, and I've been buying its stock consistently for many years. And guess what? We're currently seeing it trade at some of its most attractive valuations ever. And do I understand the reason behind this? Not really. Nobody seems to be able to give me a clear, convincing explanation. It's just, well, sometimes Wall Street acts in ways that are hard to fathom. I certainly understand the concerns around tariffs and their potential short-term impact on Amazon's business. But tell me, what is the long-term effect? That's the question that informs my investment thesis for Amazon. Remember, it's not about perfectly timing the bottom or relying on technical charts and predictions. It's about strategically adding shares when a great company is trading at a discount. This is a form of modified dollar cost averaging, simply continuing to invest through a market downturn. That's precisely what I'm doing with Amazon. For me, anything below $200 is a buying opportunity, and I will continue to add to my position because I have no doubt that once the tariff-related uncertainties subside, Amazon will return to its usual strong performance. I'm actually excited about the opportunity to buy at these levels. If Wall Street wants to remain pessimistic or even become more so, I'll gladly take advantage of it without hesitation. Before we get to the final stock on my list, let's briefly touch on Tesla. You know it's a frequently discussed stock here, and I want to share my perspective, regardless of whether it aligns with everyone's views. In my opinion, Tesla was trading at a rich valuation heading into its recent earnings report. Even before the earnings were released, there wasn't much that could have been said on that call to fundamentally alter that short-term valuation. Now, as you know, I'm a long-term investor, but in the short term, valuation still matters. Granted, it's not at the extreme overvaluation levels we saw in 2021 that was, in hindsight, clearly unsustainable. The current valuation isn't in that same crazy territory. However, I already hold a significant number of Tesla shares, accumulated since 2020. Again, I don't chase hype. I buy shares when they offer a compelling discount based on valuation, not just because the stock price has dropped. There's a crucial nuance there that every investor needs to understand. Now, I know some Tesla bulls might disagree with my assessment, pointing to potential future catalysts like Optimus and advancements in full self-driving. I understand those opportunities. I've even experienced the latest FSD firsthand. But more importantly, I understand how the stock market operates and what drives investment decisions for large institutional investors. That's why I've consistently added Tesla shares at or below my target price, which some might consider bearish, for the past 5 years. It still baffles me when some retail investors equate buying cheap shares with being bearish and buying expensive shares with being bullish. It's illogical and embodies the buy high, sell low mentality that often leads to trouble. Thankfully, the community here on this channel generally understands this, but I still see those kinds of comments occasionally, and frankly, they're misguided. The same principle applies to Palantir. I've seen comments criticizing my purchases at $7 compared to those who bought much higher, as if buying lower is somehow a sign of poor investing. You really can't make this stuff up. The key is to ignore the noise and focus on the underlying fundamentals and valuation. Over the long run, that's what truly matters. Finally, let's get to the last stock that made my buy list this month, and that is Meta. Similar to Google, I believe Meta stands out as one of the most effective advertising platforms available. And I don't anticipate that current tariff discussions will have a significant long-term impact on their overall business. Furthermore, Meta has numerous untapped avenues for monetization. They have various ways to generate revenue right now that they are strategically choosing not to fully exploit, as they are focusing on future growth initiatives. Will they be the ultimate winner in the next technological shift? Will they be the first to dominate? I don't know, and frankly, it doesn't matter. You don't have to be first or the biggest to still be a very successful company. Personally, I believe that the technological landscape of the future will have multiple major players, not just one dominant force. I'm not sure where the single winner narrative comes from, but it seems unrealistic. And no, I'm not particularly concerned about the ongoing Justice Department scrutiny of Meta either. It's a familiar pattern with big tech companies. Almost all of them, from Apple to Microsoft, have faced similar investigations at some point. These things tend to follow a predictable course and often don't lead to radical changes. So, for me, if Meta's stock price continues to decline and approaches my target buy level, I will be adding shares. Thanks for tuning in today. Remember, focusing on solid companies with strong fundamentals and buying them at attractive valuations is a cornerstone of long-term investing success.